Really?
You want to take classes?
Where?
But you only take one class a semester. Especially if you just had a baby. When is she coming?
I'm east of you. Yeah.
Especially with what's his name in the office, it's going to take forever.
Okay.
6 months.
Property values over there were going up.
They're happy? They're happy? Your older daughter?
Several of you missed the first question, which I don't understand how.
They did some curve on that.
No, there was several that got it right, but I'm really surprised. So basically, to recap on that property, you have a $900,000 loan. All payments per year.
Yeah. Oh, I thought it was 9 million.
Was it 9 million?
Well, it's 9 million. $9 million loan, 7% interest rate. Oh, let's just check it. 15-year term or amortization period. All right, get the payment. Let's see what we get.
That's what I did.
Hold on. So 900,000 present value, 7% interest rate, 15 years. Get the payment. 80, 894, 54. Then we're going to find out over 60 months.
Wait, and
This gives you 2,000,032. And add 1 million. There we have it. Okay? So the teensy tiny little trick that I threw you was to change it from annual to monthly.
And there was an amortization period. I thought a curve.
And the A+ students got it right.
It was going slow and it was kind of good.
What do you get in there?
Okay. Okay, so here is the plan. The plan is, this last bit of material for this particular chapter, for chapter 15, the new material, there's a lot of conceptual stuff, not as many calculations, okay? I think it's actually about 1, 2, 3, 4, 5, 6 out of 15 are calculations. So a lot of conceptual fluffy stuff, okay? All right, so let's just sort of kind of begin. And chapter entitled Financing Corporate Real Estate. Some of the issues surrounding that. All right, so here's the plan. We're not going to do the quiz for this one today. We're not going to have the time, okay? So this will be the first thing we'll do. And thankfully, I've built in a little bit of slack into the schedule, so we'll be fine, you know, moving forward. Next week is probably the most important week of the entire semester because we're going to be covering deal structure, okay? And of all the topics, that's probably the most important, all right? And so we've got a lot of material coming next week. So my suspicion is we'll get through the quiz on this, we'll get through the lecture on that, and then we'll have the quiz on next week's material the following week, okay? Instead of, I think I've got maybe a guest speaker, we'll cancel the guest speaker and put this in place.
I think I want the guest speaker though.
Okay, now, so let's just sort of think about corporate real estate here for a second. Part of this chapter deals with the whole thing of leasing versus owning from a corporate perspective. And some of the different reasons and the rationales for doing one versus the other, and some of the calculations involved with doing one versus the other, and kind of different motivations that you might have as a corporation for doing one thing or something else. All right, that's the sort of the setup. As a corporation that is not necessarily in the business of owning and operating real estate, they're in the business of, let's say, something else. They're in the business of running a restaurant, okay? But yet they have multiple locations that they may own or they may choose to lease. You may have a retail department store that may choose to own their real estate versus leasing it. You may have, you know, some sort of corporate headquarters that they may choose to lease versus own. You may have a manufacturing facility that they may choose to own versus lease. Okay, so those are the kind of corporate real estate decisions. It's typically the owner-occupied sort of stuff, or it's part of their core business. Does that make sense? So one of the decisions that a corporation has to make is, do they lease any or all of their facilities? Do they lease some of them? You know, under what conditions should they lease? Under what conditions should they own? Okay? And it's not an absolute cut and dried answer as to what is the best strategy. You know, in other words, it's not something that you can just automatically say, if you're a corporation, you're running a business, like a fast food business, that it's absolutely best that you own every single location. It may be best to own some of them, but not all of them. Okay? So that's part of what we're going to be sort of, I guess, thinking about and talking about as we sort of go through this material. So, starting off, what would be some of your motivations as a corporate user of the space to own your own space instead of leasing it? Okay, some tax benefits in terms of some of the deductions and depreciation and so forth that you would be able to take. Okay, absolutely. Okay, that would be a big one. You want to write that down. Okay, another one.
Day-to-day operation?
I'm sorry?
Day-to-day operation?
Okay, in what way?
I mean, if you're gonna operate a warehouse or a retail store,
Okay.
you need that space for your daily operation.
You do, but that is not necessarily a motivation to own it versus lease it. I'm talking about, what is your motivation to own the space versus lease the space?
Modifications and repairs?
Okay, then maybe you want to have more control over the space in terms of modifying the space, retrofitting the space, so that owning it would give you that freedom and flexibility, okay?
I was gonna say so.
Okay?
I would say so.
Okay?
Income.
Okay? Well, in this case, what kind of income are we talking about, though?
So if you need 5,000 square feet and you have a 25,000 square foot building, you generate income.
Okay, so you're saying, okay, having excess real estate that you can then lease out for additional income.
Yeah.
Sure, okay, then maybe you keep, that, as you say, maybe you only need 5,000 out of 25,000 as a corporation, but you lease out the rest, and part of the reason you lease out the rest is maybe you want to have room for expansion,
Yeah.
and so that you lease out the excess, okay, that makes sense, okay?
The investment value.
Okay, maybe you're going to be concerned with the investment value, but yet, with corporate real estate, and this is an interesting thing that we have to talk about, is if you're going to be a continuous operation, you're never going to sell it. I mean, think about that for a second. You know, if you're going to be, as an operating business, if you're going to continue to operate forever and ever and ever, because the corporation theoretically is a, you know, eternal sort of entity, in practical terms, maybe not so much. I mean, all we have to do is look at all the retailers that are going shh, you know, but a lot of those retailers, their biggest asset is what? The real estate. You know, and I don't want to get into all of the nitpicky little details with that, but you know, that is sometimes, but actually many times, a corporation is worth more dead than it is alive.
Yeah.
Because if they've got real estate assets that are worth millions upon billions of dollars, but their core business, whether it's retail or a restaurant or manufacturing, is dead and dying and not generating income, then it gets back to that, what have you done for me lately kind of thing. And now we have to sort of say, maybe we're better off killing off the business, selling the real estate, or repositioning the real estate for something that's more attractive in terms of a rate of return.
So, but a benefit could be, it's cheaper to actually purchase the building than to pay for a lease.
In some cases, yes, but in not all cases. You know, it could be that you just get one heck of a deal, you know, to lease the building. Maybe you're taking over the lease from somebody else that maybe went bankrupt or whatever, and the property owner's desperate to lease it out.
So from the leasing aspect, if I could get, you know, on average a 7% return for real estate with my sundries and goods as an 18% return, would I be better redeploying all of that capital?
Absolutely. That's what I'm saying. That those are the kinds of trade-offs that you've got to, you know, be considering. That, you know, it's not an absolute that you've got to go this direction, you've got to go this direction. You've got to really, you know, sort of say, what is it that but then again, you don't necessarily want to be in a situation of where you really are, well, it depends on how you look at it, but you're sitting on top of a mountain of gold with respect to the real estate, and your business is barely scraping by. And you've got to kind of say, why are we staying in business when it would make much more sense to shut everything down and then ultimately reposition it for something else?
So I guess the extreme end of leasing was Walgreens,
Right. We'll talk. Yeah.
Depreciation is not a benefit as well?
Yeah, owning it, yes. Absolutely. Okay, other benefits.
It would just be like a capital expenditure or a operating expense, so whatever benefits bottom line.
Yeah, if you own it, then yeah, you're able to take advantage of both of those in the sense of the expenditures as well as the repairs and maintenance and so forth, yeah. But if you're owning it forever, you're never really going to be able to cash in on those capital improvements in terms of you know, writing them off against your tax.
The mortgage interest is
If you have a mortgage.
Instead of paying monthly
If you have a
payments of leasing,
the mortgage interest.
make those payments towards something you eventually gonna
If you
own.
have a mortgage.
Yeah,
If you're gonna be there forever, leasing a building forever, doesn't make sense if you can lease it for 40, 30 years and own that outright.
In some cases it does, and that's what I'm saying, that while it maybe seems illogical, there's a very good case to be made in some cases for leasing because there are also benefits to leasing. With leasing, instead of getting to deduct just the interest portion of like your mortgage payment, if you're leasing, you get to deduct the whole lease payment. Okay, as a business. Exactly. And that's not insignificant, okay, because that is immediately deductible as an operating expense of the business. So
it's not amortized.
Right, it's for that year. And so part of it is also this whole thing of, you know, while you're able to do that, it may actually be in your best interest, which a lot of companies have done this, and you hear about this, but you maybe never really put two and two together, and that is a sale leaseback, which is where you may purchase it, you may build it, you may occupy it, but then at some point in time you say, okay, I no longer, you know, need to own the building, you know, I'm going to operate here for maybe the next 20, 30 years, so what I'm going to do is sell it off to somebody else and then lease it back to them for a fixed amount for the next 25, 30 years. And the tax benefits may be much more advantageous for doing that. Does that make sense? Okay, so my point with this is, you know, in your minds, most people tend to just automatically gravitate toward, I want to own the real estate, you know, for my business. And it could very well be, that is a great decision for you to make. But in other cases, it may not be because of the cost affiliated with it, the liability associated with it, and how the sort of deal is structured. I mean, I can give you a whole variety of different examples. I bought a property once that was a hardware store. This hardware store had been in operation pretty much 100 years, okay? But the business itself was kind of a dead and dying business, okay? Barely broke even, okay? But the real estate that it was sitting in was prime real estate, okay? So I bought the business, ran the business for a couple of years, and said, it really doesn't make any sense to do this because I can sell off all of the assets of the business and then reposition the real estate and be much more profitable and not have the responsibility of even having to run a day-to-day operation. Okay, does that make sense? Okay, but then you have other situations, like one of our other professors, Tom Roger, who is one of the entrepreneurship professors. He, for many years, had a whole series of Kenworth dealerships, big truck dealerships, all over the state of Florida. And he had bought every single site that the dealership, basically each location that he had, and owned outright the actual physical real estate in addition to the actual dealership itself. And then several years later, basically he was approached by Daimler, Chrysler, Mercedes-Benz to actually buy out all of his dealerships. So he sold them for millions of dollars, the dealerships. But the smart thing that he did, he retained ownership of the real estate. And so for the past probably 15, 20 years, he has been getting rental income, off of the actual sites. So he got the big lump sum of, I don't know, it was like $20 million off of the sale of the dealerships, but then, all this residual income off of the real estate, and then now is basically in that position of saying, hey, maybe it's time I start thinking about selling off the real estate, to potentially, sort of cash out of that. But the point is, there are different strategies, for that depending on what the circumstances are, okay? And so, it's not a one size kind of fits all. Another sort of example of this, have any of you ever been tangentially involved in the restaurant business in some way, shape, form, or fashion? Even as a server or whatever, okay? All right, you've tangentially been involved. Running a restaurant is very different than operating real estate. Okay? Yeah, and so you've got a whole litany of things you're having to concern yourself with. My point with that is this, that restaurant owners, they're really good, let's say, at running their restaurant. Really good at it. But when it comes to the real estate piece, they may have no knowledge, no understanding, no frame of reference as to the issues that surround the actual real estate that they occupy. And in some cases, it may not make any sense whatsoever for them to own that piece of real estate and have all the responsibilities to go along with it. Because, once again, their focus should be not on the real estate, but running the business, running the restaurant. Okay? And so this is the part that gets really tricky in sort of this whole corporate real estate thing, is sometimes dividing those two, because you have certain kinds of real estate assets that are inherently operating businesses. The perfect example are hotels. Okay? Because hotels are both real estate, but they're also an operating asset. Okay? And, so you don't necessarily have to own the building and the land to be the quote-unquote operator of the actual hotel. Okay? Does that make sense? You could be leasing the hotel from the owner, whoever that might be. All right? Now, but once again, that gets into a whole other set of issues of kind of valuing one versus the other. But my point being is, if you can make money, and a substantial amount of money off of just owning the real estate for the hotel, and you can also make money off of operating the hotel, that could be the same entity, but you could have it totally split into more than one sort of ownership, but allowing each side to maybe focus on what they're really good at. Does that make sense? Okay, so I said this is a lot of kind of conceptual things for you to sort of think about. All right, you have a question?
That's also a liability thing, too.
Well, sure. I mean, just think about it from your own sort of, any of you that have ever owned your home, okay? There's a lot of things that whenever you buy that first home, that first property, that you would never, ever in a million years have imagined that you would have to deal with or be responsible for, or whatever. Take that experience and transfer it over in the corporate setting, and the same kind of thing happens. Okay? that somebody thinks, oh, it's going to be great to own my real estate, but then, you know, all these other issues then begin to manifest themselves that are really problematic, and that in many cases tie you down maybe to that location, okay, for one reason or another. Yep.
So what would be the benefit? I have a friend that's an attorney, and she was saying to me that she's doing a deal right now where she's selling off lumber yards for this really old family that's been involved in the business forever. But they're doing immediate 30-year leasebacks on the properties. And she was like, well, what do you think is their end? And I said, well, they probably need money, and they probably can make more money than having that money tied up.
No, it's exactly, I mean, you actually, that's a perfect case in point. Lumber yards are, you know, a perfect example of big blocks of real estate. And some of the old school lumber yards are right in the middle of town, okay? And there usually are not a lot of quote unquote permanent structures on lumber yards, in the sense that a lot of it is just kind of like, they're just storage buildings, you know, in some cases very shabbily built, or, you know, whatever, just to keep things dry. And so coming in and redeveloping a lumber yard is super easy, because you're pretty much, you're knocking down some really, you know, non-significant structures, and they're, like I said, in a prime location, you know, build what you want to build. And so the owner of the lumber yard is simply saying, hey, I know I'm sitting on a mountain of gold here with basically this lumber yard, the real estate aspect of it. The lumber yard itself doesn't make any money. That's what I'm saying about, just like the hardware store. The lumber yard doesn't make any money because they simply, or you know, it's a almost a bygone era of needing a traditional lumber yard. Whenever you can now easily go to a Home Depot or a Lowe's, even as a large contractor, or, you know, order in all the materials and have it, you know, brought directly to your site, and, you know, it's just, the traditional lumber yards are just, they're just not needed. And so they're a prime example of what I was just talking about, because now those owners, if they're smart, they will do just that. They'll say, okay, we know what we've got. We may even go to the trouble of clearing the land for you, and then, in essence, then engage in this 20, 30, you know, year lease. You come in and build a high-rise apartment building, and then we'll just take a ground lease, you know, for the next 20, 30 years.
After 20, 30 years, the building is theirs.
And after 20, 30 years, the building is potentially there, depending on how the deal is structured. You know, it happens all the time. Even, I think I may have made examples of this, like with universities. Universities across the country, one of the ways they can get campus housing built is they will say to a developer, come and build your dorm on our land. We will lease the land to you for $1, and you own and operate that dorm facility or housing facility for the next 20, whatever, 30 years, but at the end of that 20, 30 years, it reverts ownership to the university.
No wonder why we
Okay? Same thing with, not this parking garage, but with parking garages at a lot of state institutions and that sort of thing. They get built, and then the operator that actually collects the revenues gets to collect the revenues for a certain period of time, and then after that's done, then the ownership reverts to whatever entity it's actually built on their land.
If the state owns the land, a private developer builds the land, the private developer, let's say it's for a college, that means the college is still going to be collecting the institutional money. But how does the developer get paid for putting up?
No, they get paid in the sense of the revenues generated off of, whether it's a parking garage or off of the dorm.
Okay, it's not, okay. Because they're doing this in Pittsburgh.
And the fees.
They are doing it.
I know. I thought it was fraud when I heard about it, because I thought they were trying to get money off of the state, because Pittsburgh University owns the land. They brought in a developer to build the project, but now they're going to lease back the project from the developer, but they're owned by the state. So if they're owned by the state of Pittsburgh, whose money is actually developing that university? The taxpayers' money. So I was like, that's a scam, and maybe they're probably even selling bonds. My mind went like, you know, really big short on it. I was like,
it's what's called a public-private partnership. Okay. And the whole idea behind it is that you can sometimes get the public sector to, the the private sector to build things on public land and get benefit from it for a set period of time, contractually, done. But there are certain benefits that can be received as well, because if it's on state-owned land, they're not paying property taxes. So you skirt, that issue. It also may be that that institution, whether it's a state institution or a nonprofit, may be able to issue bonds in their name to actually provide the loan to the developer to actually build what it is that they want to have built on their property. This happens all over the country, okay? So it's not like an isolated thing. It's a creative way of getting a project done that you want to have done, and there is value to it, from the standpoint that the university maybe doesn't have the expertise to build their own, let's say, parking garage or housing facility, or maybe they don't want to run it, whatever it may be, at least for the time being, so they can do something like this and potentially not have to deal with it.
What's happening in Pittsburgh is that because Central has been on the campus, but a lot of what's surrounding the campus, kind of like GW, where there's like historical property and there's also privately owned property in the mix of what the university owns. Like my apartment building, it was privately owned and then built by a developer, but the university owns a floor in the building that they give to athletes and stuff. And so I was like, what is the benefit that they get? But apparently they're trying to actually take full ownership down the line because people are running out of housing.
Yes. No, you actually have some college campuses, especially in places like California and New York, where the university owns the land, the university owns the building, and then they're providing subsidized, sort of housing to, students, staff, and faculty, because otherwise it would almost be impossible to afford to live there.
Yeah, it's a long-term thing because they just built, since I've been gone, they built 3 new apartment buildings, scattered around South Oakland, and it's just because instead of students leasing houses, they want them to eventually they're going to take over those residential apartments and have students stay there. It's smart.
Yep. Okay. Okay. Other questions before we move on? All right. So, just thinking about reasons that you may choose to own real estate as a corporation. May be the situation that we sort of talked about, that you're using the property in the operation of the business. Could be that, as you mentioned, maybe a diversification from the core business of you're basically acquiring extra real estate, more than you need, but yet using the income off of that to help diversify your income stream. Could very well be that you're retaining those assets that you've maybe used previously in business operations, maybe for future expansion, other reasons. And it could just be, choosing to acquire new real estate simply to, once again, for future expansion or future use or whatever it might be. All right. One just sort of little interesting statistics, at least according to your text, the corporate users control as much as 75% of all commercial real estate. Okay, so that is something to definitely consider. Okay, now one of the things that we talked about with a lease, kind of switching gears and on the leasing side of things, what did I say about the lease payment? Fully tax deductible. So if you, now we're not talking about residential leases in terms of you as an occupant, that kind of lease. We're talking about a commercial lease, okay? And that commercial lease, if you own a business and you're leasing a property from someone, the entire dollar amount of that lease payment is tax deductible as a legitimate business expense, okay? So let's say that your lease payment is $2,500 a month to lease your office space. That full $2,500 is tax deductible. Whereas if you owned it, and that was a mortgage payment, only the interest portion would be tax deductible. Okay, does that make sense?
Yes.
All right. Now, So, once again, the full lease payment, what else in terms of the lease would be deductible?
Operating?
Your
Operating what?
expenses.
Expenses. Okay, so both the lease payment as well as your operating expenses for occupying that property. So all your utility bills are going to be deductible, all of your maintenance and repairs, whatever you do, you pay out of your pocket. If it's a triple net lease, you would be able to deduct that as additional set of expenses. Okay, so basically, simply put, if you are the tenant and you are making a lease payment, that is tax deductible, as are operating expenses that you are paying as a tenant. Okay, clear? Yep.
Well, the triple net, so then they get to include.
Whatever. Everything that they actually write a check for, they would get to claim as an expense.
The property tax.
Yes. Yeah, because it's technically an expense that they are being asked to pay for. Okay.
Property tax.
If they are the ones being, now you can't have a double counting. Like for example, if the owner can't claim the property tax if he or she is not paying it.
I see.
Okay.
But if he passes on the property tax.
Yeah, if he's passing it on, then they are responsible for paying for it, and they're going to get the deduction for it.
But the owner's not.
Right, because you can't double dip. Now, I'm sure you probably have some owners trying to double dip, but no, you can't double dip. I mean, it's just kind of like one or the other is the one physically paying the bill, therefore they are the ones getting the benefit. Okay? All right. Okay. Okay. Why might you say that the value of corporate-owned real estate is irrelevant? Again, why might you say that the value of corporate-owned real estate is irrelevant to the corporation?
You may not ever want to sell it.
Okay, they're never going to sell it, which means like continuous operation.
Yeah.
Okay, that if the idea is, okay, the corporation bought it, corporation owns it, corporation continues to occupy it, who cares what it's worth? In one sense, because they're continuing to operate it. Now, at some point, you know, as we sort of talked about, it could be that somebody from the outside says, ooh, that corporation is looking really interestingly attractive because it owns all of its real estate. We might want to acquire that corporation and potentially sell off, you know, all of the assets and then acquire the real estate to be able to be repositioned into something else. So in that sense, it is relevant. But if you're talking about a, you know, a closed-in corporation where it's like a privately held corporation where no one can really buy in from the outside, then, you know, really in one sense it's irrelevant. Okay. Now, what about hidden value? So kind of the sort of parallel with that is, why is there, in many cases, like if you were to look at the balance sheet, okay, and if you understand from an accounting perspective, a balance sheet sort of shows, here are my assets, here are my liabilities, okay? One of your assets would be the real estate owned, okay? But why might there be hidden value with the real estate? Well, because in your balance sheet, normally it is not marked to market, and it is held at historical book value or historical cost or acquisition cost. So put it in another term that maybe you could easily, you know, kind of relate to. Let's say that you as an individual bought a house 30 years ago and you paid $100,000 for that house. Okay? Well, if you were a corporation, your balance sheet would show that house as being worth $100,000. Okay? Now, if you were to market, what that means is then you would say, okay, let's find out what it's worth today, and then put that number into the balance sheet. But that's not the way it works, as a general rule. Most of the time, those assets are held at that historical book value cost. And so in many cases when you're looking at sort of the balance sheet for a lot of these corporations with ownership of real estate, what you're not really seeing is that hidden value of that real estate because no one has really valued it in recent history to really see what it's truly worth today. Does that make sense? They've been too busy running their business to really even consider what that value is in terms of their balance sheet. Does that make sense?
It could go down too, right?
Oh, absolutely. Could go down. So the value of that real estate could be nothing, you know, or substantially less than what they paid for.
And also, and on that note, then, when you're looking at purchasing a business, you should actually be taking into account, even if you're not interested in the business, you should be taking into account the real estate value that the business might actually own, because that can actually be the worth of the business.
That's precisely what I'm saying.
Okay.
That's precisely what I'm saying, because just like with me buying a hardware store, I went into that pretty much, I don't really want to own a hardware store. I don't want to operate a hardware store. But what I saw was, oh, here's this building, prime location, good condition. They're basically selling the business plus the real estate for less than the real estate could be sold for. I mean, it's totally wackadoo, in terms of trying to, wrap your head around it, because they're looking at it as the value is in the business, not in the real estate.
Is that the case right now for some Winn-Dixie's places? Because I see some of the Winn-Dixies, there's no business really in these places, and the real estate really is prime.
No, it's true of a lot of retailers. That's the point. You have a lot of these old school retailers that own their real estate. So they have no cost in terms of operating really the real estate. Because here's the thing. The old school mentality was if you owned a retail business, you would spend between 7 to 10% of your gross sales on the real estate component. Okay? So that if you were doing, $10 million a year in gross sales, that means that you could spend up to $1 million a year on not buying the real estate, but in other words, the actual out-of-pocket annual cost of dealing, whether you're leasing or whether you're owning, you can spend up to 10% on the high end. On the sort of the lower end, about 7%. So you can easily back into, like for example, if you're doing commercial leases, all right, you pretty much have to know that whatever dollar amount they're paying on an annual basis should be no more than in that 7 to 10% range. And then you kind of almost back into it and sort of say, do they have a chance of succeeding? It's a very simple sort of analysis. Because I see it happen all the time. You get somebody that says, "Ooh, I want to open up a business," and then they go in and they realize that their real estate costs are like 30% of their gross sales. They can't survive. It's impossible.
So the 10% is of the gross
sales.
Gross sales.
Okay.
Or whatever they're.
That's the high end. It really 7 to 10% is kind of the normal sweet spot. Okay. But here's the thing, this is trying to make my point, getting back to, so if you own your real estate as one of these retailers and you've owned it for 50 years, everything is paid for, think about that cost. It's almost nothing in terms of your real estate cost. So that gives you a little bit of a margin to then be able to compete against other people, okay? But that margin is not going to last forever, because at some point your sales are continuing to decline, and you're not that little extra margin is not going to be there to save you. Is my point. Okay, it'll save you for a while, but not forever. Okay.
The question I had was, why did you hold on to why did you run the hardware store?
Well, for the first couple of years, I was like, let me see if I can make this thing work, and if making some changes and whatever, but the reality was it was just excuse me,
À la skis.
just sort of a dead and dying business.
Because it was old, that's why you wanted to hold on to it? Because it's like.
No, I didn't want to hold on. Well,
Ah, so happy.
I looked at it like this. I was willing to give it a chance, you know, because it was an established business, and I didn't want to look like completely a profiteer, you know. So I was like, you know, coming in, own it for a couple of years, and then legitimately could walk away selling it and not be run out of town.
Conscience clear.
Right. Because, you know, I mean, even with that business, you know, you've got a half a dozen employees,
That's right.
you know, that you are, in essence, you know, saying goodbye, you know, and that have maybe been there for many years, but, you know, it's just part of, you know, business. Pure and simple.
You know, we get called a vulture capitalist.
Yeah.
Two questions. Do you have a real estate license and can't, like the lease back or whatever, can't they charge you based on your gross receipts for the year? Didn't we talk about something like that last time?
Yes and yes. Okay.
I saw it.
All right. Let's see. What's next? So, a corporation, in addition to being able to go out and get a traditional mortgage on a property, like, for example, let's say that, I don't know, I'm AT&T, and AT&T could go out, get a traditional mortgage on a building that they want to acquire, or a space that they want to acquire, or whatever, go through all the traditional brain damage of basically getting, you know, the property with a mortgage on it, or, as a corporation, they could do what? They could issue bonds or they could issue stock, okay? And by issuing bonds, that is a form of debt, okay? And it's possible if they have a really high bond rating, that means that they can sell those bonds at a bargain basement price with a really low interest rate. Yes?
Yes.
Okay? So it might actually be advantageous for some larger corporations to sell bonds and they use that money to buy the real estate that they're going to buy, as opposed to going to a traditional bank and getting a mortgage. It might be cheaper, substantially cheaper. And especially whenever interest rates are now, you know, starting to creep back up, those corporate bond, you know, rates are, you know, in many cases can be really low. I mean, at one point, you know, the spread, you know, could be, you know, 5–6% or more. Well, that makes a big difference in terms of their borrowing cost.
Why would somebody buy a corporate bond like that? Because when you buy
Low
it, it's
risk.
higher than the current.
Low risk,
Yeah.
simply put. But the lender may be constrained on what they can lend at in terms of, you know, you're talking about a traditional mortgage.
Yeah, I see.
Okay?
There was an article recently on should you buy Apple stock or Apple bonds? And they said that Apple has enough capital that even if the government bonds go up, they can still pay face value and it not cost them anything with what they have in the bank right now. It was called Apple stock versus.
I mean, what is the late? I don't even want. I mean, it's some ridiculous number. How many billions upon billions of dollars they have sitting in the bank?
Yeah.
I think it's over 500 billion. It close to
Yeah.
close to $1
$250
trillion.
billion, or yeah, I remember 250, 260.
It
But
close to $1
yeah,
trillion. They
a
have.
lot of cash. Okay, so yeah, they don't need to be issuing bonds unless they really.
They have close to $1 trillion.
Okay. Other questions? Okay. All right. Trying to get all the conceptual fluffy stuff out of the way before we do the calculations. Okay.
Okay, my thing is, I don't mind this business model, like, I don't know but my problem is, things,
Yes.
it's exactly like this. You need to balance it.
Yes.
It's not balanced.
The community system. You come in and own this. You become the community system.
Okay. You need to understand the difference between an operating lease and a financial lease. Anybody have any idea of what each of those are and how they relate to real estate?
I think it's about long term, no? It's about,
Sorry, what?
It's about the term.
Part of it. There's several different little things, but as a general rule, operating leases theoretically are shorter term. theoretically. And financial leases are longer term or over, in many cases, the life of the asset, whatever that might be. Okay? And there's some little gray areas there as to kind of which category it may fit in, but it matters partially because of how historically they were treated on your balance sheet. Okay? Now, things have changed. Okay? Anybody remember the corporation Enron?
Yeah.
You know, from like 15, 20 years ago, okay? And they were the king of creating what were called synthetic leases, okay? And basically making what really was a financial lease look like an operating lease, and for tax purposes, or specifically for purposes of how it was reported, it made the company look good. A simple answer. It made it look good because they were effectively saying, we don't really have any long-term sort of financial obligations. They're all these sort of quote-unquote short-term, and we don't really have them. It's some sort of sub-corporation that we are somehow indirectly sort of connected to. And it was like this whole weird sort of, it was a scam. I mean, for all intents and purposes, we can call it what it is, or was. And, but since then, the law has been changed. You've heard of like Sarbanes-Oxley?
Yeah.
That name may ring a bell? Okay.
That's the law.
Well, I'm sorry?
That's the law.
It's the new law. And, well, not new, but it's been around for a few years now, but it changed how leases were treated. And you're saying, well, why are we talking about this in the real estate class? Because it basically impacts how we go about classifying these leases. And so at one point, the tax advantage and the operational advantage of having it classified one versus the other made a huge amount of difference in terms of how a company was looked at. Like, for example, let me try to put things into context here. For many years, you had the situation of where everyone wanted to classify their lease as an operating lease, saying it was a short-term obligation and therefore really didn't affect them. And here's what I'm trying to get at. That with an operating lease on your balance sheet, on the balance sheet, it was simply an operating expense. Okay? Whereas a financial lease would show up as debt. Okay? Well, the difference in the eyes of people looking from the outside, looking into a company, would sort of say debt is a bad thing. If you've got a bunch of debt in a high debt ratio, that means that you've got a ton of financial obligations that you must absolutely, positively meet, and you can't get out of them. I'm kind of using extreme language here. But on the operating lease side, the idea theoretically was you can probably get out of these obligations relatively easy, therefore they're not this huge burden on you as a company and would not be included in terms of quote-unquote your debt. Okay, does that make sense? Now what Sarbanes-Oxley began to do is to kind of say, well, we're going to add a few other little additional tests and modifications to this to where more and more of these operating leases would be classified more as debt or as longer-term financial obligations. It would not have that kind of appeal for corporations claiming they were operating leases. Does that make sense? Okay, so that's what it really boils down to. Now, all of that being said is prior to that, you had corporations, not just Enron, you had all sorts of real estate corporations that would love to classify all of their operating leases as, or I'm sorry, all of their leases as operating leases, and not as financial leases. But with that law change, everything changed, okay? Now, those of you that have probably had San Miguel or are going to have San Miguel this summer, you're gonna talk probably a bit about this.
Yes, a lot.
Okay? Yes, you're bobbing your head, okay, yes. Yeah. So you remember some of that then?
Yes.
Okay, good, all right.
Yeah.
And so, in any event, he will get into all the nuances of that beyond the scope of what we're talking about here. But at least right now, that's the basic sort of way to think about it. All right. But the whole idea was that simply put, that the operating lease was a way to get sort of off balance sheet financing. It was a simple way to look at it. Okay? Alrighty. Now let's do some calculations. Go through all the conceptual fluffy stuff. Alright, so let's just say that we've got leasing cash flows, we've got ownership cash flows, and then we've got the difference between these. All right, so in this particular case, let's say that a 5-year ownership horizon or leasing horizon. So how much in this particular instance are we going to have to, let's say, put down for the leasing of this property? Now when you say, well, I mean, initially you're going to say, well, why don't we put down anything if we're leasing it? Well, you may have to do 10 improvements, okay? Just because you move into a space and you start leasing it doesn't mean the property owner is going to cover whatever expenses are going to be necessary to fit out the space. In other words, to turn it from basically 4 blank walls and a ceiling into the space that you're going to be able to use. So give me a dollar amount.
75,000.
That's a small one, but we'll go with that.
Small business.
Very small. Okay, 75,000 is going to be the out-of-pocket for leasing. Okay. Now, each year, excuse me, what is going to be the total lease payment that you would have? Okay, 20,000. Okay. And at the end of the leasing, is there any reversion? In other words, there's no resale price, right? You're not selling anything.
It's not yours.
It's not yours. Okay, everybody cool with that? Okay, so there's, let's say, our cash flows for the leasing. All right? Yeah.
Shouldn't those be negative?
Just hold with me for a moment. Okay? All right. So, let's see. All right, so with on the owning side of things, let's say it's a little bit more, maybe 100,000. Okay, and on the ownership side, let's also say the cash flows are maybe a little bit bigger.
30.
Okay, and at the end of that period, you're going to be able to sell the property and get some reversion out of it. So let's just say that we can add to this a reversion of
150.
115, okay? All right. Now, so let's say that those are the cash flows that we've got affiliated with this. So let's take a look at the difference then between the two. Okay, so here we got a difference of 25,000, difference of 10,000. So now let's spend a little time, let's think about this just for a minute in terms of these cash flows. Sure. All right, so let's put each of these in terms of a, this is going to be our present value. And then these can be either individual cash flows or they can be the payment amount. Same thing here. And same thing here. All right, so let's calculate, and then this is going to be our future value. Let's see what we end up with. Okay. One payment per year. Interest. Okay, this one, same thing. Yep.
And why is the payments don't have the plus and minus?
Hold me for a moment. All right, so let's take a look at this. Try to walk through and explain the logic of what we're trying to do here. All right, so this first one, we're going to basically call this the after-tax cash flows from leasing. Okay, we've got the initial outlay at time period 0 of $75,000, and then we've got the cash flows of $20,000. $20,000 a year for the 5 years. And so what we're asking for is to calculate the after-tax cash flow or the after-tax internal rate of return from leasing. Yep.
Is that your, like, net sales proceeds, or, like, per year?
No.
Okay, so is that your lease payments per year?
It is the lease payments that you are potentially receiving, yes.
So this is what somebody would be paying you?
In this particular instance, yes.
Okay.
What's your question?
I'm tied up on that because under that scenario, if we're leasing the space and we're putting $75,000 into it for tenant improvement.
That may be our cost as the property owner.
As the property owner. I'm
Yes.
looking at, okay.
Then what's the difference in the ownership on this?
Yeah, how, if you're the property owner, how are you?
Well, in that case, maybe you're having to put down payment in addition to the improvements.
No, I follow, but one side is leasing, one side is ownership.
Right.
When you're leasing, and you said I'm receiving 20 grand, if I'm leasing, I'm paying out the 20 grand? And then the ownership before I would be receiving the 30 grand?
Well, if you're the owner, you'd be receiving $20,000, which is a positive payment.
But you're not the owner on that side.
Well, I'm sorry. Well, if you are the owner and the asset is being leased,
Okay, and then the other one is if you're the owner and you're in the property?
potentially yes.
Oh my gosh. So then how is it still a payment that you're receiving?
Yeah, where's this 30 grand coming from?
So the difference would be, in essence, all the different deductions that you maybe would be able to receive as the owner versus as the tenant. What you need to focus on is just simply that this is going to be your set of cash flows on an after-tax basis associated with leasing. That's going to be your set of after-tax cash flows associated with ownership. But what we're really concerning ourselves with is the last column, which is what is the difference of the two, and then what is going to be that rate of return. Okay? And so the second column is looking at the after-tax cash flows from owning the property and what the initial outlay and the cash flows are, and what are the cash flows or the internal or after-tax internal rate of return from owning the property. And then lastly, using the differences between leasing versus owning cash flows, then calculate the after-tax rate of return on the difference between the two. Okay? Yep.
So from a business standpoint, this is like whether business wants to lease a space or own it. So that's like a lease versus a mortgage.
Yeah, to a certain extent, yes.
Okay.
Okay.
I just don't get how it's a payment that you're receiving. If you're paying it out, like you're paying rent.
But it's still, you're still out-of-pocket cost associated up front, one way or the other.
Right, you own the asset. Right. Then what's the difference on the ownership side?
Yeah,
Or whatever is the same.
Because it's all about the other expenses. We're not itemizing out all the different deductions and expenses. All I really want you to focus on is that there's a difference between the two sets of cash flows.
So that's the net, what you take
Right.
all that other stuff,
Right.
remove it, even incomes, expenses, all that's over there, and this is the net difference. So if I'm operating a business in the same space, if I lease it, my net income for these years is that. If I go to buy it, my net income are those during those years.
Right.
I follow that.
Okay. All right. What else? Yep. Okay. Got 3 more problems and then we're done. Okay, so we can get through them before the bell. All right. So, one of the things we're going to ask you to do a calculation on is what is called the mortgage equity approach to valuation. This is at the end of the chapter, okay? you might want to take a look at it at some point in terms of the actual formula. So I'm going to write the formula up here for you. Value, this is how they have it written out in the book, and I'll explain each of these variables real quick. You have your net operating income minus your rate on your debt times your debt times 1 minus the tax rate over basically your return on equity plus the debt. Looks a lot worse than what it is, okay? You've only got, basically you've got 1, 2, 3, 4, 5, 6 different variables, okay? So let's take each one of these. All right, so V is obviously value. This is basically, what this is an expansion of our good friend Irv, okay? It's just taking into account the split between debt and equity and the after-tax cost of debt. That's all it's doing, okay? So let's just hang with me for a minute, okay? So let's say net operating income okay? And this is the interest rate on the debt. D is the debt amount. T is the tax rate. And R sub E is the return on equity. Once we work through this example, I think it will all become very, very clear very quickly, okay? So it looks a little bit intimidating, but it's really not. Okay, so what we're trying to do here with this model is we're trying to value the property using a combination of the mortgage on the property as well as the equity invested in the property, thus the term mortgage equity approach, okay? All right, so in this case, let's say that we have a property. Give me the net operating income. Okay, so 100,000 will be our net operating income. All right, give me our cost of debt.
10%.
Okay, 10%. Okay, give me the amount of debt that we are taking out on this property.
5 million.
That's a bit much. I would say keep it to probably, let's say, 700,000.
I had a this world.
We could make it a little bit more than that, but yeah, I'd say this is like 700,000. Okay?
That kind of return.
Okay? And then our tax rate, we're going to say, is 28%. Okay? So now, our debt over here, same thing, 700,000. And then the denominator, okay, what sort of rate of return do we want to get on this property on our equity on an after-tax basis? 18%. Let's do something else.
9%.
9%. All right, so 9%. So now all we're going to do is just start to basically simplify, do the math. So 0.1 times 700,000 gives us 70,000. So 100,000 minus 70,000 times 0.72 over 0.09, and then over here plus 700,000. Okay, so we've simplified it a little bit. Let's simplify it some more. Okay, 100 minus 70,000 is going to be 30,000 times 0.72 over 0.09 plus 700,000.
940,000.
Continue to simplify.
940.
So 21,000 600 divided by 0.09 plus 700,000.
Of the debt.
You did, I didn't.
So 240,000 plus 700,000
940.
would give us the answer, the value for the property as 940,000. Okay, so let's go through it and kind of explain what's really going on here. So first of all, what is the value of the debt piece of this? 700,000.
700,000.
What's the value of the equity?
240.
Okay, so all you're doing is just basically adding those two together to ultimately get the value of the 940,000. Okay, so now what's actually happening though is this. Okay, is that you're saying, okay, you think about how we normally do ERV. What do? We simply take operating income divided by a cap rate, it gives us value. This is basically the same thing, it's just kind of expanded and becoming a bit more precise by taking into account what our income tax rate is, okay? So what we're doing is we're saying, okay, our NOI is $100,000, but out of that NOI, we have to pay our loan, our debt service. But what is the only piece of that that is tax deductible? Interest. So therefore, we've got to figure out how much interest that we are going to be able to deduct out of that mortgage payment. Or, I'm sorry, out of the mortgage payment, but out of the NOI. So the 100,000 minus 70,000 is just simply saying net operating income minus annual debt service, but just interest only, is going to be basically 30 grand. Okay, now that 30 grand, we need to basically take that and adjust it relative to the income tax that we would be paying. And so that adjustment is multiplying it by 1 minus the tax rate, which then gives us the 21,600 that we then divide by our equity rate of return on an after-tax basis, and then add that to the debt, and then that's where we get the value. I'm sorry?
That's really what you would like to pay for the property.
Correct. Assuming all these conditions are met. Now, here's the cool thing. You can take this very simple formula, pop it into Excel, and then play around with it, you know, and have fun with it. All I really want you to do is basically make sure that you're able to do the calculation on this. Okay, we're out of time. Please hold it. Hold 1 second. Yeah, this next one will take me at least 10 minutes. So why don't we'll just do that at the beginning of class next time. If you want to look ahead and kind of do it on your own, we're going to be calculating the after-tax weighted average cost of capital and the before-tax weighted average cost of capital. Those are the only two things remaining on the next quiz. Okay? So what we'll do is when we come in, we'll do those two things, take the quiz, and then move on to the next material. Okay? Fair enough?
We're taking this one.
I think it's permanent.
Oh, it is.